This is brought to you by John Daniel and Partners, LLP.
Thank you, and welcome everyone to our webinar. It's a monthly webinar that we hold as a firm to our clients and potential clients as part of educating our audience on the various topical issues. And for today, we are discussing tax. And specifically, we are discussing about TOT, turnover tax, VAT, capital gains tax, and of course, eTIMS. So I'll go through the slides and I will encourage participants to put in their questions, their comments in the chat section, so that we can be able to discuss them once I'm through with the slides. It will be good for it to be interactive so that we all learn, because we cannot claim to have the monopoly of knowing what happens. So in terms of timing, the webinar ordinarily takes in total about 1.5 hours, and we plan to keep time because we also understand people have their other responsibilities elsewhere. Then I'll go through the slides, and then you can be able to we reserve enough time for comments and questions at the end. And note that it's a learning session. We are not giving advice, professional advice, because professional advice is specific to a client, and it's specific to a client because it looks at the circumstances of every case. Because if you talk about income generally, for example, income may be different. There'll be employment income, there'll be business income, there'll be investment income, all manner of incomes. So the specific circumstances of every client is what is considered, so that one can be able to give comprehensive advice. I also request that we stay muted so that if there is any interruption, we avoid it unless one is speaking or one feels want to comment on a topic. First, I would want us to discuss a bit about the new tax world, if I may call it that. And I'm sure tax is becoming more and more important. Even social media, in newspapers, in the media generally, even when people are talking, tax everywhere. And which are the main drivers of this? It's good for us to appreciate the environment we are living in now. So we need to understand that governments want more revenue. They want to do more things. And if, for example, we look at Kenya specifically, politicians, when they are competing, they want to outdo each other on, we'll do this, we'll do roads, we'll do this, we'll increase salaries. So the government has a lot of needs. It needs to do a lot of things. So if it needs to do a lot of things, then it needs more money. Everybody would want a higher salary. The other day we had doctors on strike, and they negotiated for higher salaries with the government, and they agreed. So that salary will naturally come from the taxes that are paid. So the appetite for higher revenues is high. Then we also have global technology giants, the likes of Facebook, Google, and all that. They are giving us services every corner of the globe. They have customers in millions and billions. And people are transacting using those giants. So how, for example, when you subscribe to Google Drive and you pay a subscription, how does the government get money? So the fact that there are certain organizations that have developed, and especially coming from the US, mainly from the US, those organizations, they transact and they influence the globe, and governments want to get money out of their transactions. Of course, there is international trade, countries trade with one another, movement, more competition between countries. So again, the trade, goods are entering, services are being offered between or across borders, between countries and across borders. Those are important drivers. Then there is the environment, the climate change matters, environmental green movement matters, international agreements. For example, there is the Paris Agreement between countries. The other day, there was an agreement signed in Abu Dhabi, in UAE. If countries have decided, for example, to reduce the carbon footprint, then as a country in Kenya, for example, will be bound by those agreements. And then it follows that we need to encourage the green or clean energy, for example, and the government will have to set up policies that are encouraging that. Technology in use of business, in transactions, when you are transacting business, there is increased use of M-Pesa. There is use of online payments. Nowadays, people are using less and less of notes and coins, but more of digital currencies, mobile money, credit cards. So it follows that the government will have to come up with ways of getting more money from that. Those are the drivers that are affecting any changes that we see in that world. And there could be more. And those are things that we need to be conscious at the back of our minds. Now, one may need to make a choice, and this one becomes very important because when we are debating in the social world or in the social media, it's very easy to discuss. But when you are doing a business, when you are doing business, you need now to make a decision as an individual or as individuals within that organization. How to ensure that you are not on the wrong side, because you cannot fight the government as an individual. So you need to ask yourself, how can I be compliant? How can I set up my accounting right, my systems right, my procedures right, so that I am able to comply with the tax requirements and avoid any problems that may arise with the government, or at least minimize them. Good. Having talked about that background, I now want to jump into the core issues. And what I've just mentioned is probably important, just providing the background. Now let's look at turnover tax. And turnover tax, we need to understand this tax on turnover. Turnover is total revenues or total sales, what you have sold. And it is targeted at small and medium, or let's say small enterprises. So currently, those having 1 million per year annual turnover, between 1 million and 25 million. Below 1 million, I think the assumption is that it's not even within the radar of the government. That's the assumption, maybe. But as far as I know, the law is silent on that. Now you need to ask yourself, when you talk of 25 million, that's about 2 million shillings just over 2 million shillings every month. And that's a fairly, depending on the nature of the industry or the nature of your business, it may be a fairly significant business. And then the rate is 1.5% on gross sales. Note here, it's not about profit, it's what you have sold. And then you file a return every month, the 20th of the following month. Now, TOT is basically targeting those who may not sell, who may not opt to file returns, the income tax returns. And if you know about the history, then it's also targeting simplicity. It wanted to simplify, to make things simple for people who are doing business, as a way of encouraging them, so that they don't spend too much time or so much trying to comply with the tax laws. But if you are selling more than 5 million in a year, note that the TOT will be allowed for turnover between 1 million and 25. But if you are selling above 5 million, and whatever you are selling falls within the VAT Act, that means it's a VATable, what they call taxable supplies, or what the VAT law, which I've been discussing also here, what it calls taxable supplies, or what we generally call VATable. What is VATable? Then you need to register for VAT. Note, you'll be registered in that instance for VAT and for TOT. And just for us to understand where we have come from, the cry for the small business person started a long time ago. 2007 is when the TOT was first introduced. And this was, as I said, about simplicity, trying to make it as simple as possible. And people registered for it. And then at some point, the government wanted to connect that small business person, or the payment of tax to business permits, the annual business permits by the county governments. So it scrapped TOT and again introduced what is called presumptive tax. Presumptive tax is where it's presuming. It's presuming. So, and it was put at 15%. Then again, 2019, it was reintroduced. This time, just like it was from 2007, initially it was for sole proprietors, but now it became even for companies. But again, there are certain businesses that are restricted. Like in 2019, turnover was adjusted from 1 million to 50 million. And that was mainly because of COVID, trying to bring in a softer environment for businesses during the difficult times of COVID. Now, 2023, last year, the Finance Act, which brought a lot of political discussions, again, it was introduced 3% of gross. And that's what is currently prevailing until now we get to 2024, which will also be, I mean, I'm sure you have seen the finance bill, which is already in discussion and people are giving their views all over. So TOT has a long history, and it's good to know that it is targeting the small person, but you need to ask yourself, what is your journey if you want to be in the TOT regime? At what point would you want to transition to the income tax regime, and how to go about it? Those are important things that you need to consider. And it will be good for you to be conscious about those requirements that will bind you to TOT and what may require you to remain in, to go to income tax, filing through the ordinary income tax. Now, some certain incomes, certain businesses are exempted from turnover tax, should not register for turnover tax. Rental income is one of them. And I guess you can see why. And management professional fees or professional services business. Those two, the very first thing is the margins. Because if you think about it, TOT, the fact that it's based on turnover, it disadvantages somebody who is having very thin margins. Somebody with very huge sales, but very thin margins is disadvantaged by TOT. So you need to think about it. When you are choosing TOT, the nature of your business, what kind of things do you sell? What are your margins? Let me just give an example. If you are selling soft drinks, and let's say you have a huge turnover of, let's say, 100 million, yet your margin is just 1%, then it tells you your profit will be 1 million. But if you are in TOT and we apply 3% on the 100 million, then it means you pay 3 million. That may be an extreme example, but it's just to demonstrate that the nature of your business, what you are selling, the services you are giving matters. So the government decided to restrict, not to allow anybody who is getting rental income, that means landlords who are getting rental income, and professionals who are offering management professional training, because by their nature they have higher margins and they'll be going directly to TOT because it will be an advantage to them. Then also other things that don't qualify for TOT is where investment income, which is qualifying for withholding under Income Tax Act, such as qualifying dividends or interest. And then for non-resident taxpayers, they are not allowed to be under TOT. So briefly, that is about TOT. I will now move to VAT, and I'll encourage that if there are questions on TOT, you can put them in the chat. If there are comments, so that we can be able to discuss them later. Now, for VAT, VAT is value-added tax, and in some circles, people have joked about very annoying tax. Especially when it was introduced in Kenya way back in 1990. I remember this VAT was also introduced in Europe, like in UK, it caused a lot of riots in 1989, those who can remember, because it was seen like kind of applying to everybody, non-discriminatory. It was seen like unfair, and of course, change will always bring in challenges. But it was seen to be a better way than sales tax, and so Kenya passed that act, Chapter 486 of the laws of Kenya, But in 2013, that act was repealed and replaced with a fresh VAT Act, VAT law, 2013. If you're familiar with the Kenyan, the ways of naming acts in Kenya, previously they used to be numbered. Chapter 486, like income tax, you'll find is chapter 470 and all that. Companies Act used to be chapter 486. Now we talk of VAT Acts based on the number, or laws based on the year in which they were passed. So VAT Act 2013, Companies Act you'll find is 2015 when it was introduced as a new law. Now, it was a major change because previously the government used to amend the VAT Act using the finance bill, just like we do now, but decided to overhaul, and that's how the government works. When it decides to remove this and introduce a completely new law. And it's an indirect tax, indirect in that it's based on expenditure. It is loaded on goods and services. As you consume those goods and services, you pay VAT at the shop level, at the till when you are paying. If you look at the supermarket, for example, when they give you a receipt for various items you have bought, in the accounting system, they'll have a breakdown of the items, and of course they show at the end there what is VAT. So they account for that to Kenya Revenue Authority. It is value-added tax because at various stages, different players account for every value they add. It's a tax on the value that you add as a trader. Those are mechanics of calculation, and it may not be good to discuss so much of them in this forum. In terms of registration, VAT you need to register if you have annual sales. If you are first trading in taxable supplies. Taxable supplies is what qualifies under the VAT, under VAT law. And generally, you'll find in VAT Act 2013, all items, all goods and services are taxable supplies unless specifically exempted, and they are exempted in the schedules of VAT 2013, of VAT Act 2013. So unless it is specifically exempted, or it is removed in a very specific way, then it qualifies to be a taxable supply. And therefore, again, based on your turnover, annual sales, up to 5 million. Once you hit 5 million, then within 30 days, you are expected to register with the KRA. So even if you had a PIN, you'd be expected to tell KRA that now you have a new tax obligation. And nowadays we do it through iTax. So you need to add the VAT obligation within 30 days of qualifying. If you do beyond that, then KRA can penalize you. So you may not want to get into problems with KRA in terms of penalties, because they become unnecessary expenses. You can also register voluntarily if your turnover is below 5 million, but you are trading in taxable supplies. For example, a professional firm that has just started, you are offering professional services, and you know professional services are taxable supplies based on the law. So you can voluntarily seek registration. And of course, KRA needs to approve that. So again, through the process of iTax. Now, with effect from January this year, you get pre-filled VAT returns, and which now simplifies filing of returns. And it is pre-filled. Why? Because we are in the era of eTIMS. I'll be discussing about eTIMS. The fact that you've been charged VAT by others, and through your PIN, they were able to invoice through eTIMS. Again, you, in the course of your trading, you have issued invoices through eTIMS. Then cumulatively, those transactions accumulate in eTIMS, and you can be able to get a pre-filled return. You will appreciate that this is a major thing, based on what I had stated earlier, that this is a major change from what we were having previously. And it's nothing new. It's good for us to know that. It's not just in Kenya. It's happening in very many other countries. I am very familiar with Rwanda, Tanzania. It's working. And of course, in the developed world, it has been working for some time. So there's nothing new. And then by implication, then it means whatever you are not processing through eTIMS will not be allowed. It will not be considered as input VAT, or you will not be able to claim it. So it's good now to know who you are transacting with. The people you are transacting with, are they giving you eTIMS? Are they processing their transactions through eTIMS? And you'll find now, besides VAT, eTIMS is trading across VAT and income tax. And we'll be discussing about eTIMS. Other requirements for VAT. Within 6 months, you can claim VAT, input VAT. That means if you had been charged VAT and you have not considered it in month 1, then you can consider it in the subsequent months, up to 6 months. And of course, KRA expects you to have supporting documentation. KRA assumes an ideal situation, of course, or the law allows an ideal situation, so there'll be complexities in running your business. And because of those complexities, you'll want to take advantage of input VAT to reduce on what you are paying to KRA. So if you had been charged, it means you want to reduce the VAT amount that you are paying or what you have charged your clients. So within 6 months, you do that. And there is also an obligation to maintain proper records to support all transactions. And this is across any requirement to do the tax. Remember, the tax man is dealing with thousands or hundreds of thousands, I think even now millions of taxpayers. So the taxman will assume that by default, based on whatever information KRA has, it will assume by default, and you'll be required now to prove on your side what you are claiming. And if you make a claim, automatically then the ball is in your court to support what you are asserting. If you are asserting that you had spent a certain amount, or if a certain credit was, it was like you loaning personal money to your business, or you got a loan, it also follows that you must have the loan agreement and all the receipts that pertains to that transaction. You keep those records for 5 years, and the language is either English or Swahili. I'm sure that will not be a problem for majority of us. But foreigners, people who have come to Kenya and maybe they don't have English background, they may have problems with that, but they need to ensure that they are conscious. It's a requirement you keep them in English or Swahili. because those are the official languages or the national languages. Then you file the return by the 20th of the following month. I remember at some point it had been, there was an idea to do it within 5 days, even 10 days has been mentioned. The government would want to get money as soon as possible. So I'll not be surprised to see that period shortened in future. And again, as we go more into technology, the understanding initially was that the 20 days you have between the end of the month and the following, and the 20th, you have enough time to go through your books and reconcile and all that. But now in the era of technology and in the era of eTIMS, you can be sure that we'll be going to more a shorter duration, because the government would want money as soon as possible. About credits and refunds, if, for example, you are claiming more, what we call input VAT is what you have been charged by others. And output VAT is what you have charged your customers. So if you have been charged more by others than you are charging, it means you have a credit. So it is, in theory, at least you should be refunded. You've been charged more than you are charging others. You should be refunded. But KRA expects you to carry forward that credit to the subsequent month. It only caters for the ones that are perennial credits by the nature of their business. If they are perennially on credit. And these are mainly exporters, those who are exporting, like flower exporters, for example, or horticultural exporters, because their exports are zero-based. They are zero-rated. So the input VAT, what they have been charged, they will not be able to recover because the output is rated zero. So they end up accumulating a large credit, and out of that, then KRA refunds. And they make an application and they give all the supporting information. And of course, KRA considers those applications and they refund. Now, this may take some time. Sometimes KRA conducts audits. Sometimes KRA calls for additional information. Sometimes it takes time to get the refund. So it is good to know about that and know the procedures that you need to follow to get your refund. But the refund will not come just because of a single month or second month credit. It will come because by the nature of your business, you have extra credit. Sorry, you have a credit on a perennial. By the nature of your business is that you'll have credit all the time. Now, there are some changes which are also coming. Now, we don't want to say the Finance Act 2024 is finalized. It has not been finalized. It's currently a finance bill. And this has been published. The law requires this to be published. And right now we are in the discussion phase, because after, in the month of June, the bill will be tabled in Parliament, and the government will give its budget statement. And here we need to understand how things work, because the finance bill amends various laws. It's good for us to know that. The finance bill that is introduced annually around the budget time, it amends various laws. It will amend the Banking Act, for example. It will also amend Income Tax Act. It will amend, quite a number of laws. It's kind of a shortcut for government to amend different laws to suit its fiscal and even monetary policies. Fiscal meaning to do with revenue raising, monetary meaning to do with how the interest rates work. So the government has introduced the finance bill, and in the finance bill, based on the discussions, the parliament will discuss this, and it will drop based on the representations from various parties, including individuals like ourselves. The government will make a decision. Parliament will make a decision and decide to drop this, to add this, to add this. Now, note that the government at the end of the day needs money. So even if there is debate so much about, for example, VAT on bread, if the government politically feels there is a lot of backlash about VAT on bread, it can transfer it to something else. At the end of the day, it still needs the same money. It's a balancing act. Which area is going to be taxed more? Which area is going to spread less? So we expect VAT on bread. Probably I've had political statements that it will be dropped. I don't know, maybe it will. Then there is VAT on financial transactions, financial services. And this is where, if you go back to what I stated earlier at the beginning, you find now the drivers of the modern taxation dispensation. We are in an era where the government, people are trading more through M-Pesa, for example, making money through M-Pesa, transacting through M-Pesa, online payments, credit cards. So the government is coming in, is getting interested. It introduced excise duty on M-Pesa transactions, or those the money transfer transactions, but now it is introducing VAT. Again, of course, there'll be discussions, and maybe the government might drop some of it, it may not. So we'll wait and see what has been dropped. The threshold is also moving, has been proposed to move from 5 million to 8 million. I guess this is to accommodate the hasra, the so-called hasra politically, so that the small person is not so much pushed into a lot of compliance expenses. How much the government will benefit, maybe I don't know, but it depends on who you ask, and maybe now it will help to keep off. To keep people within a lower. They don't need to register for VAT, and especially for those who are in TOT, as I mentioned earlier. If you are in a TOT environment and you have 5 million, you go to 6 million, you will still not be obliged to register for VAT until you get to 8 million. Exemption of transfer of business as a going concern from VAT. If you are transferring one business to the other, transfer of businesses is through selling shares from one person to the other. This may not be the shares which are sold through the stock exchange, but is transfer of a business as a going concern. You are selling me your business and I'm buying it. Application of VAT on betting, gaming. There's a lot of betting, especially with our youth. It's very common. And you'll find very many companies have opened up. It has also become easy because of technology. You only need to put in certain technology so that people can be able to access it from anywhere. Previously, rotaries and the betting used to be only in physical environments, but now, because of technology, people can do it through their phones, through their computers, And therefore, the government is interested because, again, many people are doing it, many transactions, sometimes involving huge amounts of money. So the government is also interested. A reduction of time to remit recovered bad debts from 60 days to 30 days. That's a summary about VAT. I'll now want to discuss about eTIMS. And eTIMS is now the new, I mean, it's the where everybody is now required to go. And eTIMS is electronic tax invoice management system. The journey again for this eTIMS is a long way. The government tried a long time. It even developed software, tried a lot of other initiatives. Somehow they did it work. Maybe this is the time, and it is working already. It's already working. It was tested very well, piloted for some time last year, and now it is with us. That's why it became mandatory, and it will be more and more important going forward. And you can understand why, again, based on what I said earlier, because we are becoming more, and cost of compliance. There is that push to reduce the cost of compliance. And the government is dealing with very many people. It does not want to go visiting you in your home or in your business premises every time. So with the technology, the government can be able to get you through your various activities, your various transactions. So with eTIMS, we are required to issue tax invoices. Be able to issue tax invoices. That means we comply with income tax because we are required to issue tax invoices by the Income Tax Act. And then you are also able to maintain record of your transactions, the electronic invoices that you've issued. They are accumulated in eTIMS. And then it is also able to monitor your stock. And this is important, of course, for those who sell physical items. If, for example, you are selling motor vehicles, you have a big yard, you have imported motor vehicles, and then you have sold some you have not sold. So you might declare VAT on what you have sold, but the government would be keen to see how many units or how many vehicles are remaining. And it is something verifiable. They can be able to come and check. And of course, it was empowered more by the VAT Act 2013. And the notice came that with effect from 1st January 2024, every invoice, every expense that will be recognized will only be recognized if it has gone through eTIMS. Now, this is something that will be big and big. I don't know, yesterday's paper was talking about even doctors pushing patients to pay in cash to avoid registration in eTIMS. Many people have even started saying, no, we don't need to use M-Pesa. Let's now go to cash, notes, and coins to avoid eTIMS. But those are short-term measures because this is a shift that we cannot move away from. It's there in law and we will not be able to avoid it. Even if you avoid it today, tomorrow it will still catch up with you. If you think about it now, if you register a company, the registrar exchanges that data with the KRA. If you open a bank account, the bank is obliged to get your PIN. So KRA again knows your bank account or your bank accounts. If you sell from one person to the other, you have to go through eTIMS. So how much you have made, again, KRA knows. If you sell land, you need to sell through VAT. So it is a move that we cannot run away from. And it is important that we be conscious of that so that we can be able to comply and avoid problems in whatever form. There are some things that have been exempted from eTIMS, and it's good to understand them. Emoluments means salaries, allowances, personal allowances you pay to employees, to staff. Note that exemptions is just a way of saying KRA is telling you it already knows this. It already has this information, because anybody you are paying as an employee or anybody who is earning a salary is required to have a PIN. So if you are declaring salaries as an expense, already KRA knows who you are paying. It can have a breakdown of individuals that you have paid. Again, imports. Those who are importing goods, for example, the vehicles I've just talked about. Because you are importing, again, at the point of entry, the port of entry, for example, through Mombasa, you'll process those entries through what is called a customs management system. So KRA already knows what you have imported. So the data, that data is already there. So you don't, and of course, I would want to imagine KRA is able to exchange. I mean, the two systems, the eTIMS and customs management system, are able to exchange information so that based on your PIN, it can be able to come up with a story about how much you've imported and how much you have sold, and whatever expenses have been charged to you. Investment allowances. These are allowances based on investment, and here you process this through KRA, of course. The investment allowances, they're allowed for if you are making an investment. Certain restrictions, of course, to do with the sums, where you are investing, the approval processes. Again, even if you are going through, say, Kenya Investment Authority, you, at the end of the day, you are still traceable through your PIN, because KRA has to approve the investment allowances. Airline passenger ticketing. This would be is an expense if you are traveling, for example. But of course, you'd be expected to have the evidence as an expense, because you'll be traveling as an individual. And then interest expense. Interest is charged on a loan or debt you have incurred, and the organizations that issue that give loans, again, there'll be contracts between the individual or the business that is borrowing. So interest expense can easily be identified through the bank statement, through the contracts you have signed with the loan agreement between your bank and yourself. So as much as the expense will not be in eTIMS, when you're filing the return, you can be able to give supporting information on why the interest expense is the much you have indicated. So those areas are exempted. And of course, for good reasons. It's just the convenience and the data KRA has a way of getting it. Then with eTIMS, it comes in different solutions, and they are targeted at different users. If, for example, you have stock, there is a pay point which is Windows based. you are selling from a single location, like a shop or a hardware shop, for example. And there is stock, movement of stock, the different items. So there is that option. You may be having different points, pay points, 1, 2, several pay points, like branches. So you'll have a different solution which is suitable for you, which is again based on Windows. Windows as an operating system here. We are talking about operating systems because of the technology you are using, the computer you are using. Then PayPoint eTIMS, which is based on the Tabloid, Android operating system, version 8 and above, and which also has stock module. That means you can be able to do it with your phone or your tablet. Online portal eTIMS, which is for service sector. If you are giving services like professional services, and here now you don't need a stock module because you are not selling physical items that you need to track. So you can use the online portal eTIMS. There is also virtual sales control units and online sales control units, which provides integration with your bidding system. Depending on the software you are using, you can have that integration. And these are things that you need now the decisions that you need to think about and consciously plan for them. eTIMS Lite, which is web-based. You can it's accessible through eCitizen. eCitizen is becoming like the single point of interaction. If you log into eCitizen, you see the government is adding more and more services there. And there are very many services that you can only do through eTIMS now. So again, eTIMS Lite is available through eTIMS. You can also use USSD, that's *222#. This is for individuals or sole proprietors. If you don't have a smartphone, you can use the USSD. This allows for different people, including now those without smartphones. How do you onboard in eTIMS? You need to sign up in eTIMS. It's a system in KRA. You can just Google eTIMS online. It is separate from iTax. It's not that it's a different organization. It's the same organization, only that these are systems and they talk together. They are able to interact. So you sign up to eTIMS and do a service request for the appropriate software solution. The software solutions that I've just talked about, and you'll be required now to submit different documents. You'll be required to give documents so that KRA can know you. Is kind of a KYC. And then you wait the approval process to go through KRA, and then you follow installation and training. I must commend KRA because it has been very keen on training people, training new taxpayers. As soon as you register, you start getting emails to attend free online trainings, which are good and which helps now to promote compliance and educate the taxpayers. If you allow me now, I'll go to the final part, which is on capital gains tax. And capital gain, again, is different from a profit. Sometimes people confuse these things and they wonder what is a gain and what's a profit. A capital gain is when you have sold an asset. You have sold an asset. It's not like selling inventory, on a day-to-day basis. It's an asset. An asset you are holding. You're having an asset, and an asset like land or a property, or even now a whole company. That is an asset that you had as an investment. So effective 1st January 2015, it was introduced, and it has raised a lot of debate. Previously in Kenya, we used to shout that we don't have capital gains tax, so it was a good thing. But I think the government realized it was losing a lot of revenue based on the transactions that were happening, and it introduced capital gains tax. So it was increased from last year from 5% to 15%. That is 15% of net gain. Remember now, a gain is that you have sold an asset. Let's say you have sold it for 50 million. How much had it costed you to acquire that asset? Maybe 20 million. So you have a gross gain there of 30 million, the difference between 50 million and 20 million. But again, in the course of transacting, there could be legal fees. There could be stamp duty. There could be certain expenses relating to that transaction, the disposal or the sale of that asset. That's why you're allowed now to reduce that gain to get what is called net gain. And it's a final tax. Final meaning, as soon as you paid that gain, you don't now need to come again when you're filing the annual income tax returns and declare that gain and again be taxed. No, it is a final tax based on what you have done. Remember, it's a gain on the asset. So you need to adjust the gain so that you get the net gain. And it is good here now to know that KRA will ask you for evidence. It will ask you for evidence. Those who have filed capital gains taxes, you will realize that as soon as you have made the transaction, as soon as you have filed, you'll receive an email from KRA telling you, please send supporting document for this, please, So it's always good to be very careful and ensure that it's documented. And when people are selling property here, sometimes people tend to underestimate and I think that whoever is buying the land is the one to bother with the gain. It's the person who is selling who is gaining and who is required now to file. So you need to be conscious of that. And it's payable by the person transferring the property. That's very important. And whether resident or non-resident. So before you celebrate about the much you have sold your plot at or your property at, you need to be conscious that the KRA is also interested. Then there are certain exemptions. If you are transferring just to get a loan or a secure debt, you may be transferring to the person who is giving you a loan. So you need to be very conscious of that. Then transferring to the, if for example, transferring because of a deceased person, to do with the, I mean, if you are the personal representative, you are getting it so that you can transfer it to somebody else, because that's assumed not to be in the course of doing your business, or issuance of a company for shares or debentures. Debentures are debt instruments. Shares are equity meaning owners. So issuance of shares, again, is exempted from capital gains tax. If you are transferring to to a liquidator by order of a court. Like if a company, for example, is moving, I mean, is under liquidation, is because of it's being liquidated, so there'll be transfer from the company to the liquidator. That's exempted, or transfer between spouses in form of when you are settling a divorce settlement, or separation agreement to an immediate family member. And of course, all this, remember the supporting document. I can't overemphasize this. Don't try to be clever and tie an ordinary transaction, trying to make somebody your immediate family member because you have transacted. You better do it cleanly, because the KRA will always come for you. It is because you are doing it and it has all the information. Again, on transfer of securities traded by Securities Exchange licensed by CMA, like the Nairobi Securities Exchange is one of them. It's licensed by CMA, Capital Markets Authority. So again, that is exempted. Transfer of title of immovable property to a family trust. Sometimes people, instead of subdividing family property, they opt to transfer that to a single trust for the benefit of the whole beneficiaries, the family beneficiaries, instead of having it as a single, as a broken down like land. People are used to subdividing, but sometimes people opt to have the whole property transferred to a family trust. So that is exempted from capital gains tax. So I would want to pause at this point and hand it over back to Frida, and know if there are questions, comments that we can address through the chat. Thank you. Take over, Frida.
Thank you so much, Dad, for that wonderful presentation. Yes, there are questions on the chat box. I can see one from Mark. He's asking, will per diem be subjected to eTIMS?
Okay. Will per diem be subject to eTIMS? Okay, now what is per diem? Per diem is daily allowance. And daily allowance for somebody traveling so that you have accommodation or you have subsistence outside your normal place of work. Now, this has been a very interesting item, and I know especially those who work in public sector is a major thing because sometimes it attracts, I mean, it sometimes it's a lot of money, especially those who are doing international traveling. Now, and in the Income Tax Act, they have a limitation. I can't remember whether they had 3,000 shillings as the limit, and anything above that was deemed to be a benefit. If it is deemed to be a benefit, then it falls under what I've called emoluments, because the Income Tax Act, I think, is the early sections of the Income Tax Act. They define emoluments, from salaries, allowances, benefits, by whatever name you call them, that are arising because of your employment. So if you are getting per diem, it's part of emolument. Now the issue is whether it's taxed. It's not even the issue of whether it's processed through eTIMS, but whether it's taxed. That I've seen even in the current finance bill, there has been some discussion. I don't know where I saw it, but it was being claimed that MPs want to exempt themselves. But emoluments generally are exempted from eTIMS. Whether it is taxable or not, that may be a different debate, especially going forward. And let's understand that the finance bill will bring a lot of discussion initially when it is published. But remember, it will not be passed until probably in October. We are in May now. It will not be passed because it will be debated a lot, and sometimes the media loses interest in the discussions in Parliament. But sometimes they remove and add some things. So if it is added something new is added in October, you need to know what has been added. Of course, some of the things are implemented immediately in July. But you need to know if they are changing the limit, for example, for per diems. It means, and when I say the limit is 3,000, I'm not saying you must pay 3,000. You can pay even more if you can afford. The issue is anything above is considered as emolument, as a benefit. Now, this may be different from reimbursement. It's also good I mentioned that. It may be different from reimbursement. Because if, for example, you spend in a hotel and that hotel is invoicing the company, then it's like you are per diem indirectly, if I may call it that. It's per diem indirectly, and it can be processed through eTIMS. I hope I've addressed that question clearly. The other question, if I may go through what has been submitted, submission of recovered bad debts and the reduction from 60 to 30 days. I'm not sure. I'm not sure what that is. Can you expound more on the recovery of bad debts, the reduction from sorry. Oh yeah, this is Dennis. Kindly expound more on the submission of recovered debts and the reduction from as it is being proposed. Okay. But bad debts are expenses. If I may just step back a bit. Bad debts are allowed as expenses in the Income Tax Act, and they need to be specific. Specific means it can be traced to a particular invoice that you had issued and you are not paid. And therefore, you need to prove that you have not been paid. The fact that you've not been paid is what is making it an expense, meaning it's no longer income. It is the other side now. It is allowed to be a deduction. So for you to be allowed, that's a period that is being reduced from 60 to 30 days. I can check on the specifics because the approval process, of course, has to be processed through ITAX. So the government will want to know who is this person who has not paid. I mean, not that they punish for not paying, but for it to be allowed now, this is more or less to encourage faster business in terms of credit, but it is also a way of ensuring that there is more accountability. Remember, eTIMS transactions are the ones people are working through eTIMS. And if it has been processed through eTIMS and you've not paid, then you are allowed. It's a friendly way of allowing accountability, if I may put it that way. Does eTIMS allow for apply for non-profit companies? Yes. It's across the board. It's across the board. Remember, when we say a not-for-profit company, that's a legal nature of an organization, and it's out of choice that you are doing it. But remember, eTIMS is not targeting profits. It's just targeting trading. It's targeting accountability, openness in terms of trading. So if, as an organization, you've been charged an expense, remember, even not-for-profit companies file returns. Remember, they file even income tax returns. It's only that their aim is not driven by profit. It does not even mean they don't make profit. Some organizations even make profit, but they plow it back. They don't distribute it to their members. They just take it back to their operations. So eTIMS applies to all. And as long as you have a PIN, then you need to know that it works. What happens to expenses that are incurred on international companies, e.g. Uber? They are not providing eTIMS receipts. Okay, here eTIMS, this one, I think, I don't know, at individual level, I think there is no eTIMS receipt, but if you enter at a corporate level, it means you have to transact, you have to register with them and they be billing you. Then the invoice they have is eTIMS. The only problem now, I don't know whether the transport company, the likes of Uber, Bolt, have an electronic eTIMS. They may have to go that way if they have not gone already, so that individuals can be able to put it. But now you may also be required yourself to put your own PIN. I noted that in a supermarket in Rwanda. In Rwanda, if you are over the counter and you're just buying something as an individual, they ask you for your PIN, whether you need PIN or not, and that's where we are heading, because if you don't want your PIN, if you don't want to give your PIN, it means it's not for a business thing. You are the final consumer. But if you want a PIN, it's because you want to go and claim. You want to go and claim that in terms of as an expense for your business. It's a business expense. So that's where we are also heading, even our supermarkets, Ubers, and all manner of organizations. Thank you, Lynette. I've seen Lynette together saying the session was insightful. Shadrach Mwangi is asking, are there capital gains tax charged on transactions such as mergers and acquisitions, for example, a bank acquiring another bank? Yes, that's a transfer. That's a transfer, whole ownership. That's transfer of a company. I remember this one raised some issues because of the last regime, President Uhuru, where one bank was exempted I don't know whether it was, no, it was, I think it was stamp duty, not capital gains, but this one, there is. I think actually these are the kind of transactions that are targeted by capital gains tax. So definitely with mergers, acquisitions, capital gains tax applies. I think those are the only comments I'm seeing. Frida, unless there's something else I would want to pose at this point. Thank you.
Thank you so much, Dan. I don't see any other question in the chat section area. Only a comment from Liz asking whether the recording will be emailed to the participants. Yes, the recording will be emailed to all the participants of this webinar. Thank you so much for joining us. And maybe, Dan, before we wind up, what would be your parting shot to the attendees of this webinar?
Oh, thank you, Frida. I think I'll still go back to what I started with at the beginning. That we need to understand that we're in a different world now, world full of technology, world full of visibility through online. The government is even now going for digital ID. If you remember, there was a time we were registering for, I can't remember what it was called. So we are going to an era where it will be very easy to know what you are doing. The government can be able to know what you are doing. I remember in China during COVID time, they were even tracking people in the streets. Everybody, they could be able, the street scanners could tell who is having higher temperature than the other, and even your history, where you have come from, where you stay, and all that. And that's where we are heading. Right now, if Google alone is to be asked, it can tell where you stay, it can tell where you work, it can tell where you usually have a drink, if you do, probably with who, because it can also trace who is in the neighborhood regularly. So those things are very, very, I mean, we are now in a different world. So you need to be conscious, and especially as a business person, one very important thing is accounting. Because if you're not doing accounting properly, then you'll not be able to defend yourself. You'll not be able to file the correct returns. And that's why it's important to engage even professionals like ourselves. I'm not saying we must be able to do it for you, but you need to make a choice whether you are in business or you are not. And if you are in business, engage a professional, discuss with a professional, which is the best way. For example, accounting now, you can be able to do online, like for us, we use Zero Accounting, which is an online platform where you can even use your phone to do accounting. And those simple decisions, including filing, you can even file online. You don't need to worry about maintaining huge files. So that is where we are going, and you need to be conscious of that. Don't try to fight the taxman. You'll not win that war as an individual. You can go to the streets and demonstrate if politicians call for demonstrations, but ultimately you'll be accountable alone as an individual. So it's good to be conscious and be prepared so that you safeguard your business as an individual and you seek to grow professionally. That would be my parting shot. And thank you everyone for listening to me. Thank you, Frida, for the hosting.
Thank you so much, Dan. I agree we should not be running from the taxman, but we make the taxman our friend and be compliant to all the regulations. Allow me to share my screen. So we are John Daniel and Partners LLP. We are certified public accountants. We are based in Nairobi, Kilimani. We believe in teamwork, integrity, and excellence, and we empower you to run your business. Our inspiration is to see every other business succeed. That's why we would like you to entrust us with your business. Allow professionals to handle your bookkeeping or your accounting needs, internal audits, to do your external audits, and also to offer you advisory services, be it tax and management advisory as you focus on other endeavors of your businesses. It's good to engage professionals. And the good thing about consulting us is that we are a multi-talented team, all-rounded, with both trainers who have attended local and international trainings. We have CPA finalists in our accounting firm. We are also zero certified advisors and are passionate about business and consulting. Our key practitioners are Dan Chege, who was making the presentation today, and also we have John Guri. Some of our clients are in various industries, be it in real estate, manufacturing industries, as shown there. And also we have worked with the government in various places. Our key partners include the Zero Accounting software. We have also partnered with Workpay and UPeosoft and ERP Next software. So what kind of approach do we use when doing business? We seek first to understand your needs, then we contract. We plan on how to do the work you have given us. We consult with you. And the key thing is to develop a close relationship with our clients because you have entrusted us with your business. Thank you so much for your time. We are looking forward to having you in our next webinar, which will take place in June, 27th June. We will be sharing the recordings of today's webinar and also the link to the upcoming webinar for June. To reach us, you can dial the phone number provided there, 0722 817 818, or email us at info@johndaniel.co.ke. We are also happy to host you in our office that's in Kilimani, Nairobi. Thank you so much.
Okay, thank you. Bye-bye.
This is brought to you by John Daniel and Partners, LLP.